In this week's analysis, we'll be talking about gold, crude oil, US 100, which is Nasdaq, and GBP-USD. If you love the content, please like, subscribe, and leave your thoughts in the comment section down below. If you're interested in learning to trade Forex like a professional, check out the complete Forex trading course on Udemy. I have the link attached in the description below. Without further ado, we're starting with a gold chart on the 1 hour time frame. And as you all know, gold has been a solid bullish trend for the past few years now, I think a year or two. And right now we're looking for another opportunity to go long. So the last time we talked about gold, we just bounced off of this area of support, which led to this a bullish move to the upside, giving us TP of around 1,200 pips. And I hope a lot of you caught that from our last video. So today I'm going to be looking for another position to go long around the moving averages. Like you all know, I track the trend using the 200 EMA and the 200 SMA on various time frames. So this is a 1 hour time frame. We've bounced here once. I think we're going to get another bounce over here when we do tag this moving average again, if we do tag those moving averages. So right now, bullish case scenario, will be waiting for price to creep into the moving average. Then I expect a good bounce to the upside. If that happens, my entry is going to be placed immediately after the bounce, giving us a very solid tight stop loss just below the moving average. By that time, these moving averages would have crept up, so they climb up with time, right? So let's say by next week, Tuesday, Wednesday, the moving average will probably be around these levels. And if we do get those flush outs to the bottom, which will also coincide or correspond with this area of support, so something like this, which will give us a nice confluence. Yeah, so this will give us a solid confirmation of a bullish setup where we go long, like I explained before, we go long when we bounce up of this area of value and moving averages. Stop loss can be placed underneath the moving averages, and take profit target first one can be placed around these highs, and the rest of our positions trade as we go higher. So this will give you a risk to reward ratio of approximately SL of 120 pips or 100 pips. First TP will be 500 or 600 pips. So a risk to reward ratio of a minimum of 1 to 6, right? So this is what I watch out for when following trends, especially trends like gold. So gold trends hard, right? So when trends hard, you can track those trends using these moving averages and just trade the bounce off of those moving averages. So if this breaks through, so if the moving averages doesn't hold, then I go to the 2 hours time frame. So on the 2 hours time frame, you can see the moving average is still creeping upwards gradually. We haven't had any bounce on that moving average yet. So if the moving average on the 1 hour time frame doesn't hold, that's why we go with good risk management. It gives you a tighter risk to reward ratio, and then if it doesn't hold, we will watch out to see if we come into the one on the 2 hours time frame. And I think if the first one doesn't hold, then the 2 hours time frame probably going to hold, and we see a move to the upside. And same principle is going to apply for entries. We go we go long after the bounce, and we take profits when we climb to these highs. So these highs here, or trailing our positions as we go higher, because if we take out these highs, then we're going to be in price discovery, right? So going back to the 1 hour time frame, but I'm focused right now on the moving averages on the 1 hour time frame, because I think we're going to see a bounce there, at least a first initial bounce. I don't think we're going to slice through immediately. So the first initial bounce where I open my position, then if we get a maybe 200 pips bounce, I'm going to adjust my stop loss to my entry position to safeguard the trade in order for me to run the trade risk free, right? So you could scale in multiple positions with this setup. One position coming in when we bounce off of the moving average, second one coming in when we take out this area of resistance. So meanwhile, your second position is going to be significantly lower than the one underneath, so that you could ride both positions using the unrealized profit from your position at the bottom. So that's briefly for this week's analysis. I'm not going to be talking about anything concerning going short, because I think it's going to be ridiculous to think about going short on gold at this stage of the market, right? That's it briefly for this week's analysis on gold. Moving on, we're talking about crude oil. So crude oil, real quick, we've been in a solid bearish trend over a few years now. You can see price keeps making lower highs and lower lows. So 1, 2, 3. So this one tried to take out these highs, but we got rejected immediately. And now I do think this is probably going to come all the way down, right? This is probably going to come all the way down to these lows, where we try to break out again for a bearish continuation, or probably see another bounce to the upside So gold can be tricky sometimes to trade, but you have to understand that it's all about, probabilities, right? So are you would you rather go short when we take out this trend line, or you go short around this area of resistance? So right now, for a bearish case scenario for me, I'm going to be going short immediately. We take out this trend line, which would be on Monday, I think, if I'm right. So when we take out this trend line, I'm going to go short. Stop loss is going to be placed above this high, so that's going to be approximately 120 to 150 pips SL. And my take profit target is going to be close to these lows, probably around these price levels. And this will give us a risk to reward ratio of 1 to 2, I think, or 1 to 3. So SL 150 pips, TP 300 pips, right? So that's a risk to reward ratio of 1 to 2 approximately, right? Is that right? Yeah. So 140 pips SL, 300 pips TP. Yeah. So a risk to reward ratio of 1 to 2, which is decent in my opinion for a commodity like crude oil. And that's it. So for a long position, I don't think I'll be going long now or anytime soon. So I'm only going to go long if we see strong bullish breakout above this area of resistance. So let's say, for example, we come down here, then we make a big move up, get a good consolidation around here, then followed by another big move up. Then this will be my confirmation of a possible trend reversal, right? Start going long. But for now, we're still safe. Trend is still bearish, and I'm only going to look forward to going short on this. So remember, risk management, low risk, low positions, and just take it slowly at your own pace, depending on how big of an account you have, right? So good risk management, stay disciplined, and do not rush into any trades. Meanwhile, I implore you to do your own research. Don't take everything I say. Just take everything I say with a grain of salt, right? So do your own research and make sure you're on the right side of the market when you open those trade positions. So that's it briefly for crude oil. Moving on, we're talking about Nasdaq. So Nasdaq, real quick. This is an interesting one, risky one, of course. Nasdaq has been bullish for quite some time now. You can see all the way. In fact, it's been bullish for over 20 years, right? If you just exclude these brief dumps, because these are just brief blips in the market, and over a long period of time, you don't notice them. You only see the main trend, which is bullish, right? So right now, this is 2 hours time frame on Nasdaq, and we just bounced off of the 2 hours moving average. So again, 200 EMA, 200 SMA, I use them to track the trend, and I do think we're going to go higher, right? So when the market opens, I'm not currently in on this trade. I'm just going to be patient enough to see if we get a flash dump. So let's say a flash dump into this area of value, then I'm going to look for positions to go long, just so I can get a good risk to reward ratio, right? So if I go long around here, right, so stop loss will be placed underneath the moving averages, and my take profit target first one can be placed here. So I missed a position. I missed entry around these price levels when we target this place. So this would have given me a good solid entry where I can adjust my SL to entry. But right now, going long here at the current price levels would mean, going long here, just going to explain real quick. So going long here would mean stop loss should be placed around these price levels to be safe, right? Because there's a good chance market could consolidate, coming all the way down here, move up. So Nasdaq can be crazy like this sometimes, right? So I know you may just be expecting a massive move to the upside because we took out this trend line, we had a bounce, but there's a good chance we still go flush these lows right before we go higher. And there's a good chance we also break below the moving averages. So why not open your trades with a very tight risk to reward ratio, so that even if you're wrong, you lose a very little amount of money. But if you are right, then you make a banger, right? So that's the reason why I'm going to be patient to see if we get a brief dump. Then I'm going to go long when we go as low as these price levels. So this will give me a risk to reward ratio of XL of approximately 120 pips, first TP of approximately 500 pips. So that's a risk to reward ratio of 1 to 4, as the case may be. So this is solid or better than going long at these current price levels and placing my stop loss around here, which will give me a risk to reward ratio of 1 to 1, in fact 1, because then, or 1 to 2 as the case may be, then I'll be exposed to a stop loss of 350 pips with a TP of approximately 250 pips for first TP. In fact, the stop loss is even wider than the first take profit target, right? And you can't assume that we're going to take out the resistance. So even if we do, you have to trade based off of what the chart is showing you, right? So that's why it's logical to go to pick the best possible positions when you trade assets like Nasdaq, right? Because they can be very volatile. Mind you, this week we're gonna be having an NFP on Friday, Friday next week. So, which may cause some serious volatility in the market, and you don't want to be caught in no man's land. So, right now, this is no man's land because the distance to your potential stop loss is so wide that you have to, start thinking about saving your account if you make a mistake going long here. So, for me, I'm even going to get rid of this trend line for now so it doesn't get you confused. So for me, for Nasdaq, I'm going to be waiting for a pullback to the downside. If we get a pullback, possibly scraping the 2 hours moving average again, then I'm going to look for my positions to go long. So if this happens, so we're going to get something like this. Maybe the moving averages may have crept up like this. Then I'm going to look for those bounce around these levels. So if I can get a bounce there, it means my entry is going to be placed, it means my entry is going to be placed around here after the bounce. Stop loss will be placed underneath that bounce, giving me a tighter risk to reward ratio, and I can, just go long. I can even go heavy if I like because my stop loss is now so tight, right? And take profit will be around these highs. First one will be around these highs, right? So this gives you a risk to reward ratio. Just going through it one more time. SL of approximately 100 pips, not even up to, right? But if you want a wider SL, so you can go for 100 pips SL to 500 pips TP. So a risk reward ratio of 1 to 5, and that just gives you, puts you in a better position to, make better profits with low risk, minimum risk if that happens. So it's all about patience, and I'd rather be patient or miss the trade, right? I'd rather miss the trade if we don't come back to these lows than enter here in no man's land and just, get fucked by the market if we do come here, right? Because when you get this large drawdown, you'll be too scared to go long again because you're already in a deep loss or a deep drawdown, all right? That's it briefly for Nasdaq. Meanwhile, if we lose the 2 hours moving average, then you can go to the 4 hours time frame. So the 4 hours time frame looks a bit more solid because the moving average on the 4 hours time frame flushes and aligns with these highs, right? These highs where we had this good breakout. So it would be nice to see price retesting this area of value, coming to the moving averages on the 4 hours time frame for that bounce. So this will even give you a better trade positions, right? But like I said in the go chart, I'm going to wait to see if we come down into the moving averages on the 2 hours time frame. I'm going to try entry, right? Because the stop loss is so tight, so I barely lose nothing with respect to what I have in my account, right? So if I lose this position, then I go to the one on the 4 hours time frame and try again. Again, it's all about probability, and because the risk to reward ratio is so tight, so if I'm right on the 2 hours time frame, it's going to make up for the loss I make here on the 1 hour time frame. So it's all about probability. There's no perfect way to take positions, especially for Nasdaq, US 30, US 500. If you do think, well, get into a solid trend. So these are track trends and get a best risk to reward ratio when trading trends. When we're in a ranging market, it's quite different. You can see over here. Here we're trending, right? So we're ranging. So there's no way to, trade those bounce, and it would be illogical to trade bounce within a market structure like this. But right now, we've clearly broken from this area of resistance, and you can see we've had the first bounce, right? So right now, we'll see if we sustain this bounce and see if we get another positions to go long. And you just follow the trend with these moving averages, and you'll be good to go. That's it briefly for Nasdaq. Lastly, we're talking about GBP-USD. So GBP-USD, really nice one. DXY had a very good pump last week, following interest rate cuts and other rhetoric from the Feds. So right now, we had a good bounce off of this area of value, which also coincides with a bounce from this trend line all the way to April of 2025. So April this year, one bounce here, then August, another bounce here. Now in September, another bounce. So I do think this sets us up for a nice rally to the upside on GBP-USD. I think the DXY is going to collapse this coming week following the NFP. So if that happens, you want to look for trade opportunities around this price level. So let's say, for example, we get something like this, then you want to go long, right? So if you go long, let's say you go long around here, if we get a confirmation of a consolidation, a bullish breakout, right, or a solid breakout from this trend line, your stop loss can be placed underneath these lows. So it just gives you an opportunity to, put your stop loss in a safe zone, because if we take out this area of support, take out this trend line, take out this low, it means this trade and this setup would have been invalidated, right? So this would give you, and your take profit target could be as high as this place for the first take profit target. Second one can be as high as this highs, while you trail the rest of your positions as you go higher if you want to. But I like to just scale out. So I'm probably going to take some profit here and exit the rest of my positions here and see if we take out the resistance level of the symmetrical triangle, because you know this pattern is a symmetrical triangle, right? So if we go long there, so this will give you a risk reward ratio of what? Potential stop loss of 80 pips, still very wide in my opinion for GBP-USD, and TP first target to be 120 pips, second target to be 270 pips. So a risk reward ratio of 1 to 2, 1 to 3, which is also decent for an asset like a currency pair, like GBP-USD. So if you need a tighter risk to reward ratio, what you could do is, you know, wait for price to maybe dump. If we do get a dump, then pick a position here, right? So you're either going to be right or wrong, but if you're wrong, you probably going to lose very little amount of money, right, compared to entry around these highs, which could also turn out to be wrong, right? So your confirmation, right, has already been this bounce. So a pullback into this area of value may just give you another opportunity to go long with a tighter, you know, stop loss, right? So this will put your stop loss at approximately 30 pips, and if you are right, your take profit target is going to be around 200 pips, as the case may be. So that's going to be a risk ratio of 1 to 5 or so, or 1 to 6, which is decent in my opinion. So that's how I evaluate trade setup, and I'm trying to refine how I enter positions now to get a better risk to reward ratio, because the market is ever changing, right? So you have to adapt, transform your strategy, and just adapt to the market to make the most out of the price action opportunity the market presents. That's it briefly for this week's analysis. If you agree with me, please leave your thoughts in the comment section down below. If you also disagree with me, please also leave your thoughts in the comment section down below. I may be able to learn a thing or two from you. That's it from this week's analysis. See you next week.